Good evening. My name is Professor Felix Obi, or I am Professor Felix Obi. My name is Felix Obi. This is Economics 330, Global Trade and Political Economy, Medgar Evers College. Welcome to Office Hour Lecture. Today is Tuesday, November 21st, 2023. This is week 13, module 13. And as I hope you now know from this week's assessment, today's lecture will be on the international debt crisis. Of course, as I'm sure you also remember, last week's lecture was on international economic development. And these two themes are not unrelated. There is a cost to development, and quite often countries borrow to finance development. And when those investments in development and infrastructure don't pan out, a debt crisis could very well ensue. As we learned earlier in the international monetary relations, when a country is unable to pay for all its imports from its export revenue, it may have to borrow to make up the difference. These borrowing may accumulate, thereby making it difficult for a country to participate in world trade, which in turn creates social, economic, and political problems. Now, it's important to really tease this out a little bit. Obviously, countries can borrow for a number of reasons. One of the worst ways to borrow is to borrow to support your budget. That would be the individual equivalent of paying your bills with a credit card. You can see how that's a bad idea. However, if, for instance, you wanted to get that fancy new job and you wanted a great education, it may be a smart idea to take a small college loan to earn a degree from Medgar Evers College. Now, that's an investment. That would be akin to a company or a country investing in its infrastructure. So, and a country gets its foreign revenue, obviously, from foreign direct investment and exports. When the value of exports exceeds the value of imports, the country is said to suffer a balance of trade deterioration, and it can no longer afford to finance imports. So with this, there are a few learning outcomes that really comes in with this, international debt crisis. So the textbook cause of international debt crisis includes one, irresponsible lending on the part of creditors. So sometimes creditors just extend credit to countries that are not ready for that level of investment, or where the investment may be suboptimal, or worse, when a country wants to borrow to support its budget. Generally, that's not a good idea. Two, mismanagement on the part of the debtors. So if a debtor borrows money and mismanages the money, that could be one reason why a debt crisis may exist. And three, worldwide recession. Economic growth, population expansion, and increased government spending drive the need for borrowing. And typically during economic downturns, governments intensify borrowing to stimulate economic activity and provide financial support, which can, at least in the short term, exacerbate debt crisis. And here's what I really mean by that very quickly. During COVID, obviously, there was an economic contraction, and there were lots of job losses, especially for people who work in the service industry. Malls were closed, retail outlets were closed, and folks lost income. And obviously, there was COVID checks that went out. I think there were 2 rounds of COVID payments. For many countries, they would have to borrow to support that kind of social spending. And the social spending was intended to stimulate economic activity. Indeed, that social spending had an unintended consequence. There is a strong argument that it created inflation. It led to inflation, and here is why. So people were dislocated from their jobs. Businesses were not functioning and couldn't earn income. So quite rightly, the government injected stimulus measures, uh, um, financial assistance to especially small businesses, and cash assistance to lower income Americans. This allowed Americans to be able to purchase, and people had time on their hand and the fast internet on their laptop. So people started ordering and purchasing stuff when global manufacturing and the supply chain, the links to get that goods and service, to produce the goods and service and get it to markets, was challenged, essentially because China was locked down for a long period of time. So you had a lot of money being spent chasing fewer produced goods and services. That led to an inflation. So that is one our outcome that is thought to have come with the government as a support subsidy program. Of course, there are other later drivers of the global of inflation pressures that the world has felt since COVID. But again, that's a whole different conversation. But because of 2008 financial crisis, we now also know that a laissez-faire attitude or a doctrine opposing government interference in economic affairs beyond the minimum necessary for maintenance of peace and prosperity, property rights, can lead to weak regulation, which can result in moral hazard for businesses. And the integration of especially financial markets in at least this situation can become the vehicle for contagion of international debt crisis. One key phrase and one key word. One of the phrases I've actually brought them up in a much earlier class, and I said it was one of those key phrases and keywords that you need to have in your arsenal to be able to signal to folks that you're indeed a scholar. One of it is moral hazard. But let me actually begin. Actually, there are three of them. Let me begin with laissez-faire. Laissez-faire is a French word. It means live well alone, live alone. So a number of things happen. The federal government's regulation of the mortgage industry was very lax. The assumption was that mortgage companies had an incentive not to damage their own industry, and therefore they had an incentive to self-regulate. What also happened was that mortgage companies also faced a series of pressures that does not always lead to rational choices. For instance, there is the pressure to report good earnings every quarter. There is the pressure of one department competing against the other. So in essence, what happened during the financial crisis was the commoditization of subprime mortgages. So obviously, as now, interest rate was high then. What creditors did, instead of denying applicants, subprime applicants loans, what they instead did was introduce adjusted rate mortgages. This meant that the true mortgage that you are signing up to may be something like 8 or 10%, but it would have an accelerator. In the first few years, you might need to pay only the interest rate, which would effectively, and not the principal, which would effectively bring down your payments to maybe half or a quarter of what your actual payment should be. And all these mortgages, usually you buy a mortgage company holds on to that mortgage. What they did was to securitize the mortgage. So in the same way you go to buy debt from a country, they securitized it. That means all mortgages from a particular zip code held by this company can be chopped up into little bits, and all financial institutions from around the world would buy into it. So you may have the pension fund for a teachers union in Jamaica or Trinidad investing in subprime mortgage in Brooklyn. At some point, a little bit of panic ensued in the market, and investors thought they needed to hedge their bet. So they started buying hedging instruments. To hedge, hedging instrument really means this. If, for instance, you need to, if for instance, you think you're overexposed in your mortgage portfolio, you could buy a hedge instrument that says, if the value of that tanks to this extent, you would pay me insurance to cover my losses. But for me to maintain that hedge, I have to pay you X. It's like buying insurance. You have to pay X amount every month for a defined period. Of course, when it turns out that many people who had subprime mortgages could not afford that mortgage, they started defaulting. Normally, this would have been contained to the US market. But again, as I mentioned, the securitization of mortgage debt and the internationalization of the ability to buy into US mortgage created a contagion. And that contagion means that the crisis spread all over the world. Nobody knew what bank or what financial institution or what pension fund, for that matter, was overexposed to US mortgage debacle. And that created a crisis of confidence. And with that came an economic recession. So that would also be one of the ways an international debt crisis can ensue, and indeed a broad stroke framing of how the mortgage crisis and financial crisis exploded during 2008. Obviously, when the country is in debt, they need to go into debt restructuring, which is a process that involves negotiating with creditors to reduce interest rates, extend repayment terms, or cut loan balance. So you could reduce the interest rate, which again is a conversation I was having with some students before our 5 minutes of grace started, where I mentioned that, if the price of the underlying asset is affordable, but the challenge is interest rate, and the buyer can afford to maintain payment at that high interest rate, it may not be a bad idea to buy the underlying asset, and then with the expectation that as the economy, as inflation cools off, interest rates will be reduced, and folks have the ability to refinance. But when it's a private mortgage, you refinance. When it's a national debt, you restructure. So restructuring interest rates, restructuring can help make debt situations more manageable through smaller payments, lower interest rates, or reducing overall debt burden, which is you say, okay, they're going to cancel part of your debt. And there are two major ways to reduce debt. One, bondholders can take a haircut, which is to reduce debt burden. So bondholders could say, I know we're supposed to get 10%, we're now going to take 2%. So that's one way. And very quickly, and I hope everybody understands what a bondholder is in terms of national debt. So very quickly, here's how a country can borrow money. It can go to multilateral agencies like the World Bank, or it can go to the markets, private markets, and sell a bond. So typically what happens is that an individual goes into a bank and borrows money. Because the amount governments want to borrow is so large, there is a securitization. That means that government debt will become an investment portfolio. And finance industries will come, pool money together, and loan it to the government. That is called a bond. And then they're going to pay, the government is going to pay them an interest every month. And at the end of the expiration of the bond period, they will pay off the principal. And that's how the finance industries make money. And that, i.e., the bondholder. And that is how, another way governments can get access to capital. So bondholders can take a haircut. You could negotiate payment terms. And 3, debt for equity swap. That means you say, okay, there is a question of sovereign immunity and how much sovereign immunity matters in this case. And again, I am digressing a little bit, but just to touch on the subject of sovereign immunity, for instance, there are certain assets that enjoy sovereign immunity. That means creditors cannot touch it. So no matter how much the United States owes, creditors cannot touch the White House. They cannot touch the US Capitol, as an example, that they have sovereign immunity. There are other key symbols of state and key infrastructure that also enjoys sovereign immunity. But debt for equity essentially is that your debtor would cancel part of your debt if you allow them to take control of an asset. And a classic example that is often cited and debated of the idea of debt immunity, equity swap, is the Sri Lanka's 99-year lease of the Hambantota port to China due to Sri Lanka's inability to repay the debts that financed the building of the port. Of note, many, if not all members of the Paris Club, a group of major creditor countries, excluding China, whose role is to find coordinated and sustainable solutions to payment difficulties experienced by debtor countries, have cited Hambantota port as an example of debt diplomacy, although this point is subject to debate. Debt diplomacy we will get to in, I think, the next question when we discuss the IPE perspective on debt crisis. But the next point that you might want to understand is to be able, and I think everybody in this class ought to be able to do this now, to describe the roles of the World Bank and IMF in attempting to resolve various debt crises. If you just spend 2 seconds on this, because I know we have covered this quite a bit in this class, and we have had a robust debate and a robust debate even among students in your weekly discussion on the roles of IMF and the World Bank, whether net they are here to help or here to hurt. The World Bank, as you know, has a mission to reduce poverty. They finance long-term projects in developing and underdeveloped countries. The IMF creates stability among governments, financial stability among governments, so that they are able to participate. Governments can stay stable enough and solvent enough to participate in international trade, which is the lifeblood of an economy. But going back to the idea of debt trap diplomacy, the number 4 point that needs to be understood, obviously, in this week's lecture is the different perspectives on debt crisis, different international political economic perspectives on debt crisis, or the relationship between politics and economics and between states and markets in world affairs. And there, as you know, again, we've discussed this several times, there are 3 distinct theories of in international political economy. There is the liberal theory, which would argue that international institutions are very well positioned. International institutions and systems are best positioned to address international debt crisis, i.e., the World Bank, the IMF, the World Trade Organization's ability to dispute trade and provide a rational basis for trade in goods and services and intellectual property rights protection. That these are some of the international institutions that can intervene and do regulate, and therefore make international trade more efficient and therefore reduce the likelihood of debt crisis. The second is economic nationalist or mercantilist, which again is where those who can argue, who are likely to argue the idea of countries subjecting poorer countries to a debt trap. So the economic nationalist or mercantilist states will leverage economic advantages, including debt, to advance national interest. So you use your economic might and economic advantages to advance your strategic national interest. So you create a client-patron relationship. The third perspective, of course, is the Marxist perspective, which looks at the unequal relationship between the global north and global south, the client-patron relationship between the global north and global south, and the unequal economic relationships as being the driver of being structured with some intentionality to remain unequal. And the intentionality of this unequal relationship is to advantage the patron state at the of course at the cost of subjecting periphery countries to even more poverty. So this is this week's lecture in a nutshell. I tried really hard to keep it as brief as possible. I know this is Thanksgiving weekend. There is still work to be done for those who work, and there is still school work to be done for everybody else. And yes, there has to be time for family and hopefully a little bit of our Thanksgiving. So with that, this concludes our Module 13 lecture. For next week, our Module 14, we will focus our week 14 on Module 12. This is week 13 lecture, and next week will be week 14, but Module 12. So our module is 1 week behind because there are some classes that a module covered 2 separate weeks. Anyways, our focus will be on current trends in international political economy. That's what we're going to focus on next week. So with that, it's 6:30. Lecture is officially over. Any questions?
No, Professor. Great lecture, by the way. I like today.
Thank you very much. I'm sure you liked it because it was brief and short.
Not necessarily. No.
Okay, but
it was great. It was a good lecture.
Well, thank you so very much. And really, I do wish you and all your classmates wonderful Thanksgiving. Quick note, I did send out an email informing the class that there was an extension for assignments from week 7. I hope that the entire class takes advantage of that Thanksgiving gesture, especially for students who need to play catch up. There are, however, a few caveats. The first caveat is that the maximum point you can earn on each assignment is 80% and not 100. This is because there still has to be while I want students to have the opportunity to succeed, there has to be an advantage to those who did the work on time. So the maximum score you could earn is 80%. The other caveat is that discussions where other students have to comment on your thoughts will not be subject to revisit, simply because I cannot compel students who have already participated to go back and have to comment on your work or do any such thing. So that's done. The third is to pay attention to the due date. Let's put in the work. This is the holiday season. We're headed into Thanksgiving. And right after that, we'll start heading into the holiday season. I am hoping and I'm hopeful that every student puts in the effort and puts in the work to at least earn a passing grade. I hope we can all share that goal. Of course, I'd like everyone to earn an A, but you're going to have to earn your grade, and this is that opportunity. With that, thank you. Happy Thanksgiving to everyone. Bye-bye.
Bye, Professor. Take care. Happy Thanksgiving.
Thank you.